G'day, I'm Jason Weeks. I'm the co-founder of Vendorable.com and I am here to talk to you today about rentvesting. So thank you to my man James Dapperchi from Coffee and a Case Note, shout out. But it is a common question that I get because the term rentvesting has crept into parlance in property and in the newspapers and online choice magazines, primarily because property prices have been increasing in each of the major capital cities around the world to the point at which people are finding it difficult to enter the market for the first time. And this is a combination of two factors, both of which rentvesting purports to solve. The first of which is that the individuals can't afford to save a deposit sufficiently large enough for a financier to lend to them. And the second is that in needing to take out a very large mortgage, even at the current low interest rates that we have, the amount that you need to pay each month back to the bank for principal and interest payments is too great a percentage of an individual or a household's income. And so therefore the individual chooses to rent instead of purchase, and instead look to purchase somewhere else that may have a lower purchase price in order to afford entry into the market. So that's exactly what rentvesting is. I've skipped ahead. It is renting a home for yourself in a location of your choice, and then it is purchasing a investment property somewhere else. And so you are rentvesting. You are renting in one location, but you're investing in property in another location. So some of the pros and cons are a useful way to discuss this. So on the pro side, as I mentioned, it allows entry into the property market. You certainly get to maintain, lifestyle by renting in the location of your choice, which might be different to where you'd like to invest. You can accumulate wealth in a property whilst you still maintain the opportunity to search for a dream home. It affords you some mobility, so you can continue to move around, perhaps even go overseas without the need to sell or rent out your primary residence, which can obviously be difficult. Some people would view it as there are tax advantages, but we'll discuss that a little bit later on. And the last thing is, again, location-wise, you have greater flexibility about where you might purchase, which provides a lot of opportunities. So what are some of the cons? Well, in Australia, in our jurisdiction, there are incentives such as the First Homeowners Grant that require you to live in a property for certain periods of time until you can actually flip it to an investment property. And obviously there are disincentives for trading properties too frequently. You know, we don't have land tax here in Australia like other jurisdictions do. We have quite a high stamp duty, and that's a disincentive for regular transactions of properties. So if you're looking to turn over that investment property to continue to trade up that equity into another home, that's going to be more difficult here because of how high the stamp duty is. That's not the case in other jurisdictions where they focus on land taxes or property taxes on a regular basis, but smaller proportion. There's obviously costs associated with moving. So if you do move around whilst you are renting, then there is the cost of that. There's the vacancy cost and uncertainty around the renter in your property. And then there's obviously the sort of creature comforts, which is you can't do work to a property you're living in when you're renting, and you might be constrained by sort of pets and other sort of accoutrements of a home that is yours. So obviously if you want to put solar panels on your own home to reduce your power bill, great. A landlord would not be so keen on you bolting on some solar panels to your roof. And certainly, you know, there's utilities and other things you have to maintain and upkeep for your own home, but it means you can do it to your spec. So if we use an example, I find it quite useful to think about it in terms of round numbers. So let's just bear with me, we'll keep it fairly simple. If you wanted to purchase a home in Sydney, let's say for $1 million, then on average, most banks, although you know you can get higher LVRs, loan to value ratio, as we learnt in the first video about vacant retail properties, the loan to value ratio you'll get is 80%. It's what they'd prefer unless you want to have lender's mortgage insurance and extra charges, and it certainly creates a higher risk profile for you as far as the lender is concerned. I know there'll be people who will write in the comments, and please feel free to leave them, that they can do it for no money down or 95% LVR, 97% LVR, but let's just talk plain vanilla for our example. If you had to put 80% mortgage on a property that was worth $1 million, then you'd have to have a deposit of $200,000. Now that's $200,000 you've had to have saved as an individual or a couple after tax. So in Australia we have an average rate of tax of 35%, and so actually if you gross that up, it's basically like you've had to have $300,000 worth of income extra over a period of time and save. So for many people that could be more than a decade, possibly even 2 decades worth of savings, and in that time property prices can keep going up. Obviously they've been trending down and then back up again and sideways, but again, you're not in control of the property market price movement. You're only in control of yourself, and you have to save that deposit. So that would be a case of borrowing $800,000, putting down $200,000, and if you borrowed $800,000, on average your repayment at the moment in the current interest rate environment in Australia at least is going to be somewhere between $4,000 and $4,500 a month. Now, alternate, in those same suburbs where properties cost $1 million, you could quite happily rent the same property for probably $2,500 a month. Right, all in, everything. And that would leave you the equivalent of the $4,500 you have to pay for a mortgage, minus the $2,500 you have to pay for rent. It would leave you with about $2,000 left over if you were renting, not owning. So what could you do with that $200,000? Well, people who subscribe to Rentvesting would say to you, well, you could take that $2,000 and you could quite easily service a $400,000 mortgage on a $500,000 property. And now, for example, in my suburb, you'd easily be able to get a 1-bedroom, possibly even a 2-bedroom unit for $500,000 and rent it out for $400 or $500 a week. And so if you took out a $400,000 loan using the same interest rates we did last time, your repayment is going to be around about the $1,950 to $2,000 mark. So that $2,000 gap, you'd be able to use that to pay the mortgage off on the investment property you've purchased instead of a full primary residence mortgage where it would absorb all $4,500. Now, there's a couple of things to that. The first one is both have risks attached. So obviously you could lose your job and that would make it difficult to pay the mortgage on either, including your rent. And also as well, in your investment property, you have tenants and you have vacancy and you have damage and issues, and you don't always have 100% income. In fact, it's very rare for you to be able to have 100% occupancy forever. You'll usually have large tracts of time where you've got a rented property, maybe 1, 2, 3 years, and then you'll have a short gap of 2 to 3 months where you find a new tenant, and so you'll need to factor in that gap. So it's not perfect. So what I would say is, if you rented out that new property, for example, for $400 a month, you'd have roughly around about the same amount of money as the mortgage. Now, don't forget, if you've bought a unit, or in fact, if you bought a house, you'll have upkeep. If you have a manager, you'll have to pay manager's fees. You'll have rates, charges, land tax if you have a sufficiently high enough property value, and you'll certainly have had on the way in as well stamp duty, which would need to be paid unless it's below a certain amount of the threshold. That example I gave probably wouldn't have stamp duty attached. It's probably falling below the 600,000 odd threshold, and especially if it's your first purchase. So what I would say about rent vesting is it is a good option, but remember that it's predicated on a couple of different things. You have to want to be a landlord. Like, you could just take that $2,000 a month and you could invest it in something far more passive, like an index fund or shares. I'm not giving you financial advice. You should definitely seek out excellent financial advice. But property is not the only thing that you could do with that $2,000 extra. It is requiring also that you tighten your belt such that that $2,000 extra does go to paying off the investment property instead of just using it for your own personal lifestyle. So people always say that they're under mortgage stress, and that's definitely still potentially the case in this, because you're going to have rent and a mortgage. You haven't just got that extra headroom of that money coming in whilst you rent. Again, as I said, there's transaction costs. So stamp duty, if you end up selling that property and buying another one, or you end up selling and buying your new home, you're going to incur stamp duty twice. And you will have to deal with tenants and a managing agent, unless you want a self-landlord. And also, one thing people often do is they use this rent vesting as an opportunity to invest in an area that is different to their own home location. And whilst that can seem great, long distance landlording, it's not for everyone, so you're going to be reliant on getting a good property manager, and that can be a bit hit or miss. Just something to bear in mind is Rentvesting is reliant upon a quality tenant and a quality property. And as we've seen with some of the construction issues in Australia because of the boom in property, particularly if you're going to be buying an apartment, you'd be very careful at the moment about where you would purchase and what kind of asset you'd purchase, because the last thing you'd want is to have this idea of rent vesting and then to have it turn into a nightmare in terms of capex. And so just to summarize, the idea of rent vesting is that you don't own your primary residence. You rent your primary residence, you purchase a second property. The financial benefits of the wealth accumulation of that second property can eventually translate into a much larger equity check for you to later on either sell or refinance that out and then use that to purchase your future home. It doesn't come without risks, but there are obviously a lot of rewards to it as well. It isn't for everyone. There's some great resources out there on the internet. I might drop some in the links below for you to consider. And certainly, I'd love to hear from you, one of three scenarios. The first is if you have a very strong view against rent vesting. The second would be if you love rent vesting and it's something you do. And the third would be you don't rent vest in the property sense, as in rent property and invest in property, but you do rent and you take the income and instead invest in other assets like bonds or shares or alternative investments or your business. I'd love to hear from all three of you on that. In that case, and by all means, please send in any questions about other topics. Thanks again to James Dapperty for rent vesting as a topic.